There is a document that almost every founder signs, believing they understand it. Most founders read it once, quickly, the night before signing. Some send it to a lawyer. Very few actually understands the structure they are agreeing to. This is usually somewhere between 8 and 20 pages long. And hidden inside those pages are decisions that will determine how much of the company you truly own, who controls the board when pressure enters the room, whether you make money in an acquisitions, whether investments gets paid before you do, and whether your own voting power means anything when the company becomes valuable. The document is called the term sheet, and today we are going to read it properly. Every clause, every provision, every line, founders usually skim because it sounds standard. Because the dangerous part of our term sheets are really the headline valuation. They are the sentences buried in the middle, the ones that quietly decide control, leverage and economics years before those conflicts actually appears. I am Navarun Sen. This is Inside the Deal Process, episode 3.
I'm Gurmeet Kaur, and I want to be upfront about something. Most term sheet explainers gives you a glossary. They tell you and what the words mean and move on. We are not doing that today. We are going to tell you what actually happens at Series A, at acquisition, at the moment your company is worth something. When the term sheet you signed 2 or 3 years earlier comes back into the room, because there are 3 provisions in almost every seed term sheet that founders treat as standard, sign without negotiating, and then spend years wishing they hadn't. By the end of this episode, you will know all 3 and what you will know what to do about them before you sign it. Let's go.
Before we go clause by clause, let's establish what a term sheet actually is and what it is not. A term sheet is a summary of the proposed investment. It is not the final legal agreement. The final legal agreements come later. The stock purchase agreement, the investor rights, agreement, the voting agreement, the right of first refusal, and co-sale agreement. Those documents are longer, more technical, and written in language most founders never fully read. But here's the important part. By the time those documents arrive, the real negotiation is usually already over, because the term sheet is the blueprint. Once the structure is accepted in the term sheet, the lawyers are mostly converting that structure into legal language. This is where many founders make a costly mistake. They treat the term sheet like a preliminary conversation, as if the real negotiation will happen later during the legal drafting. Usually, it doesn't. If a clause is already accepted in the term sheet, removing it later becomes extremely difficult because the investors now treat it as agreed economics or agreed governance. Which means the moment a founder casually says, "We will sort this out in legal," they're often negotiating after leverage has already disappeared. Now, a standard seed stage term sheet usually contains 5 sections. Section 1, the offering. How much money is being invested, at what valuation, and through what structure? Preferred equity, SAFE, convertible notes, or direct shares. This is the section everybody reads carefully. Section 2, capitalization. The ownership structure before and after investment. Ironically, this is one of the most financially important sections in the document. Section 3, investors' rights, information rights, pro rata participation, future investment rights. This is where investors secure long-term positioning inside the company. Section 4, governance. Board composition, voting thresholds, approved mechanics, control structure. This section determines who actually controls the company. And Section 5, protective provision and special clauses, anti-dilution liquidation preference, drag-along rights, founder vesting, no-shop clauses. These are the provisions that seem harmless when the company is small and becomes extremely important once the company becomes valuable. Today, we are going to walk through all of it using the real-world hypothetical. Tariq and Nina built a SaaS platform for legal operation terms, contract management, approval workflows, compliance tracking. The one company has crossed $220,000 in ARR. Orion Ventures has offered them $5 million at an $18 million pre-money valuation. On paper, it looks straightforward. Friday morning, they are expected to sign. Tonight, we are going to read the documents. Before they do, I will hand it to Ms. Kaur, who is going to begin with the valuation mechanics.
The front page of Tariq and Nina's term sheet says this: $5 million investment, 18 million pre-money valuation. Simple math. The company is worth 18 million before the money goes in. After the 5 million, it is worth 23 million. Orion owns 5 of 23, which is 21.7%. That number, 21.7%, is what Tariq and Nina will tell people they gave up. It is the number they will remember. It's not the number that reflects the reality. Here is what is buried 3 paragraphs down in the capitalization section. The pre-money valuation is calculated on a fully diluted basis, including a 15% unallocated employee option pool to be established prior to closing. This sentence is called the option pool shuffle, and it's one of the most consequential sentences in any term sheet because it means the 15% of option pool, the shares reserved for future employees' equity, is being carved out of the founder's ownership before the investment is calculated, not from owner's ownership. Here is the math. Before the round, Tariq and Nina own 100% of the company, let's say 10 million shares. To create a 15% option pool on a fully diluted post-money basis, you need to issue new shares to the option pool before the investment. Let's say that requires 1.76 million new shares. Now the total pre-investment share count is 11.76 million. Orion pays $18 million for that 11.76 million share base. So the price per share is roughly like $1.53. After the round, that the cap table looks like this. Tariq and Nina own 10 million shares, which is now 64.5% of the company. The option pool holds 1.76 million shares, 11.4%. Orion holds its new share 21.7%. The founders did not give up 21.7%. They gave up 35.5%. Their shares plus the option pool that came from their stake. This is not a scam. Option pools are real and necessary. You will need equity to hire great engineers, a VP of sales, a CFO. The question is not whether the option pool exists. The question is who pays for it and when. In the standard term sheet, founders pay for it and at the moment of highest cost during the valuation calculation rather than post investment, which would spread the dilution across all shareholders, including Orion. A founder who understands this can negotiate not to eliminate the option pool. Orion needs it, but to negotiate the size. If you can demonstrate the 10% option pool covers your hiring plan for the next 18 months, you don't need to accept 15%. Every percentage point of the option pool is a percentage point of your company, but you can only make that argument if you have read the sentence. Most founders don't. There is a second piece of that cap table section that matters just as much, and it's the fully diluted share count. The term sheet will specify whether pro rata rise for the future investor, convertible notes and existing saves are included in the dilution calculation. If you raise $500,000 SAFE 18 months ago, which Tariq and Nina did, those SAFE converts at this round, adding a new share to the cap table. Founders percentage drops again. The term sheet governs that conversion. By the time you model the option pool, the SAFE conversion and Orion's shares, Tariq and Nina's combined ownership post round is closer to 58%, not the 78% the front page implied. Now back to Mr. Sain.
Tariq and Nina now own roughly 58% of the company after the round. And in most people's understanding of ownership, they should mean control. If you own the majority, you control the company. You decide the direction. You decide whether to raise, whether to sell, whether to hire, or whether to fight through difficult periods. That is how most founders think power works. But venture-backed companies do not operate purely on ownership. Now, this is something that we should keep in mind. They operate on governance, and governance is where many founders discover far too late that majority ownership and actual control are not always the same thing. The governance section of the term sheet has three moving parts: board composition, protective provision, and voting thresholds. Let's start with board. Orion's term sheet proposes a 5% board, 2 founder seats, 1 Orion representative, and 2 independent directors, agreed upon by both parties. On paper, it sounds balanced. The founders have 2 seats, Orion has 1. Everything appears aligned, but governance problems rarely appears at the beginning. They appear later, when incentive stops matching. In the early stage, those 2 independent seats are usually left empty for months because everyone is focused on growth. The board effectively operates with 3 people: Tariq, Nina, and Orion. Everything feels collaborative. Then 3 years pass. Growth slows. A new round becomes difficult. Orion wants operational changes. Maybe they want an external CEO. Maybe they want to push towards a sales the founders do not agree with. Now those independent seats suddenly become very important. And because those directors require mutual approval, Orion has influence over who enters those seats. A board that once looked founder friendly can shift very quickly once pressure enters the room. This is not theoretical. This is a pattern that repeats itself across venture-backed companies. The second piece is protective provisions. And this is where the term sheet quietly begins limiting what the founders can actually do. Without Orion's approval, Tariq and Nina cannot sell the company. They cannot raise certain future rounds. They cannot restructure the board. They cannot take on significant debt either. They cannot issue additional equity freely. They own 58% of the company, but strategically, they now require investor approval for many of the company's most important decisions. Now, to be fair, some of these protections are reasonable. Investors need safeguards against reckless decisions. They are deploying capital into an illiquid, high-risk business. The issue is not whether protections exist. The issue is whether the thresholds are reasonable. A $250,000 debt limit may sound harmless today, but 3 years later, for a scaling company financing expansion, it can become very restrictive very quickly. The phrase issuance of new securities also sounds procedural until founders realize it may affect future hiring packages, equity incentives, or strategic additions. These are the clauses founders need to read carefully. And then we reach the third piece, voting thresholds. Some decisions require super majority approval, 60%, 70%, and sometimes 75%, which sounds manageable until multiple investors enter across multiple rounds. Now, major decisions requires coordinations between parties whose incentives may no longer fully align. The practical effect is that simple decisions can become slow, political, and extremely difficult to execute. Tariq and Nina need to understand these structures before they sign, not after. I will hand it to Ms. Kaur, who is going to introduce the first of the 3 provisions founders remember years later.
Haunting provision number 1, the liquidation preference. This is the clause that determines at the moment your company is sold, who gets paid first and how much. It's the most consequential economic clause in any term sheet. It is also because the language is dense and the scenarios feel distant when you are raising your seed round. The clause that founders are most likely to sign without modeling. Here is the clause in Orion's term sheet. In the event of any liquidation or deemed liquidation, investors shall be entitled to receive prior to and in preference to any distribution to holders of common stocks an amount equal to 1 times the original purchase price plus any declared but unpaid dividends. That is called a 1x non-participating liquidation preference. It is the market standard. It means Orion gets the $5 million back from Tariq and Nina, see $1 from an acquisition. After the Orion converts to common stock and participates in the remaining proceeds proportionally. This is fair. This is clause you want. Now, I'm going to show you what a different version of that same clause looks like and what it costs. Some term sheets, particularly in competitive markets or with less founder-friendly funds, include participating preferred. The clause reads, in the event of any liquidation, investors shall be entitled to receive their liquidation preference amount and shall participate with the common stockholders on an as converted basis in any remaining proceeds. This is called full participating preferred. And the word "and" is in that sentence is worth modeling explicitly. Tariq and Nina's company is acquired for $20 million, a good outcome, roughly 4x their post-money valuation. Let's run both scenarios. Scenario 1, 1x non-participating. Orion takes $5 million off the top. Remaining $50 million is distributed pro rata by ownership percentage. Orion owns 21.7%. They take another $3.25 million. Founders and employees share the rest. Orion's total $8.25 million from a $5 million investment. The founders on their 58% stake receive $8.7 million combined. A good outcome. Scenario 2. Full participating preferred. Orion takes $5 million off the top. Then they participate in the remaining $50 million at the 21.7% ownership. Orion receives an additional $3.25 million. Orion's total is $8.25 million. Same number. But wait, the founder $8.7 million is now reduced because the participating preferred does not cap. Orion extracts value from the common pool. If the acquisition is lower, say 12 million, the math changes dramatically. Orion takes $5 million first, remaining $7 million split by ownership. Orion gets another $1.5 million. Total Orion shares $6.52 million from a $5 million investment, 30% return. Tariq and Nina share the remaining $5.48 million on a company they built for 4 years. The participating preferred meaningfully compresses founder returns at every exit value below about 3x the post-money valuation. There is a middle ground version called a capped participating preferred, where the investor participates until they reach a multiple, say 3x, and then converts to non-participating. This is negotiable middle position that protects the investor while limiting the founder downside. The lesson is, read this clause specifically. If it says participating, model the acquisition scenario at $10 million, $20 million or $40 million before you sign. Know exactly what you are trading. It may be worth it to get the deal done, but now we are going back to Mr. Sain for haunting provision number 2.
Haunting provisions number 2, anti-dilution protection. This clause exists before investors are trying to protect themselves from one specific scenario, the down round. The down round happens when a company raises capital at a lower valuation than the previous round. Market weakens, growth slows, revenue misses expectations, entire sector fails out of favor, and suddenly the company that raised at a premium valuation 18 months earlier is now raising at a lower price. Now who wants that? But that's how it is. Investors know this happens. Anti-dilution protection is designed to reduce the damage to the ownership position if it does. Mechanically, the clause adjusts the conversion price of the investors' preferred shares, giving them additional shares if the company raises future capital at a lower valuation. Now, there are two very different versions of the clauses, and understanding the difference matters. The first version, the standard market version, is called board-based weighted average anti-dilution. The second version, the one founders should pay very close attention to, is called full ratchet anti-dilution. Let's walk through both using Tariq and Nina's company. Orion invested at roughly $1.53 per share during the seed round. Now imagine the Series A happens during a weaker market environment and the company raises at $1.20 per share. Instead, under board-based weighted average anti-dilution, Orion's conversion price adjusts partially using a formula that accounts for the size of the new issuance and the degree of the down round. The adjustment is proportional. Orion receives some protection. The founders experience some additional dilution, but the outcome remains balanced. Pain is shared across the cap table. This is why weighted average anti-dilution becomes the standard. It protects investors without destroying the founder's ownership structure. Now let's look at full ratchet. Full ratchet operates very differently. Under full ratchet, if the company raises even slightly below Orion's original share price, Orion's enter conversion price resets to the new lower valuation, not partially, fully, even if the new round is only modestly lower. So, if Orion invested at $1.53 per share and the new round happens at $1 per share, Orion's earlier shares are now effectively repriced as though they are originally invested at $1 per share, which means Orion receives additional shares to compensate for the difference without investing additional capital. Economically, their ownership expands. The dilution is absorbed largely by the founders and existing shareholders. And this is where anti-dilution becomes dangerous. Because founders often assume dilution happens gradually over time. But full ratchet can compress founders' ownership dramatically in a single financing event. In certain cases, founders lose 15 to 20% points of ownership in one round, purely because of the anti-dilution mechanics. Now, to be clear, full ratchet is not standard in healthy venture financings. It appears more often in distressed companies, bridge rounds, aggressive investor environment, or situations where investors have unusually strong leverage. But it exists, it gets signed, and many founders only fully understand it after their next financing process begins. That is why this clause matters. If the term sheet says board-based weighted average, you are operating within normal market structure. If it says full ratchet, pause, model the outcome carefully, because the clause is not just telling you how the downside allocated, it is telling you how your future investor relationship may function under stress. And that matters, because the investor you chose today are not just giving your capital, they are becoming part of your company's pressure for the next 7 to 10 years. Now, I will hand it over to Ms. Kaur, who is going to cover the third haunting provision.
Haunting provision number 3, drag along rights. If Orion and majority of preferred stockholders vote to sell the company, Tariq and Nina must vote yes, even if they don't want to sell, even if they think the price is too low, even if they have been building toward an IPO. The drag along right means the investor can drag the founders into a transaction the founders oppose. I want to sit with that for a moment because it sounds extreme, but this is standard language. It's in most term sheets, and it's designed for a legitimate reason. Investors need to know that a small number of disgruntled common stockholders cannot block a majority approved acquisition. If 90% of your shareholders want to sell and 10% refuse, no acquirer will proceed. The drag along exists to solve that coordination problem. The question is not whether drag along rights should exist, the question is who triggers them and at what threshold. In Orion's term sheet, the trigger is majority of preferred stockholders. Orion holds 21.7% of the company as preferred stock. If Orion brings in their Series A investor and they collectively hold more than 50% of the preferred, which they will by design once the Series A closes, the drag along can be triggered without the founder's support. Here is the scenario. 4 years after the seed round, Orion has been investing for 9 years. Their fund is approaching the end of its life. They need distributions. A large company offers to acquire Villa for $30 million, a 6x return for Orion, who invested a $5 million. For Tariq and Nina, who have been building for 7 years and believe the company is worth $80 million, a $30 million feels like a fire sale. Orion calls a shareholder vote. They have enough preferred stock between seed and the Series A investor to drag all shareholders into the sale. Tariq and Nina vote no. The drag along overrides them. The company is sold. This happens not commonly, but it happens, and it's perfectly legal. And it was agreed to in paragraph 14 of the seed term sheet that Tariq and Nina signed 6 years earlier at 2 in the morning, the night before they sent it back to Orion. What can founders negotiate? 3 things. First is required that the drag along also requires approval of a majority of common stock holders, not just preferred. This gives founders effective veto power. Second, negotiate a minimum price threshold. The drag along cannot be triggered below a certain acquisition price, protecting founders from being forced into a low value sale. Third is negotiate that the drag along requires board approval, including founder board seats, rather than shareholder approval. Not all of these are achievable in every negotiation, but any one of them meaningfully limits the downside. And the investor who says no to all three, who insist on an unrestricted drag along that they alone can trigger, is telling you something about how they expect to exercise power in a disagreement. Now, let's back to Mr. Sain, who is going to cover the remaining clauses in the term sheet that don't haunt. They don't haunt you forever, but can cost you significantly if you ignore them.
We covered the three provisions founders tend to remember years later. Now let's move through three additional clauses that may not completely reshape the company but can still create friction, dilution, or strategic problem if founders ignore them. First, pro rata rights. Orion's term sheet gives them the right to participate in the future funding rounds in order to maintain their ownership percentage. So, if Orion owns 21.7% after the seed round, they have the option not the obligation to invest additional capital in a later rounds to preserve that percentage. At first glance, this sounds reasonable, and in many cases, it is. Strong investors continuing the support the company can be a positive signal, but founders need to understand the downstream effect also, because future investors often want meaningful ownerships themselves. A serious Series A investors may want 20%, 25%, sometimes more. Now imagine existing seed investors are also exercising pro rata rights aggressively. The round starts becoming crowded. Suddenly, the founder is not just raising capital, they are managing competing ownership expectations between existing investors and incoming investors. Deals become slower, allocations become political, and sometimes strong future investors walk away because the cap table structure becomes difficult to work with. This is why founders should model future rounds early, not just the current one. Pro rata rights are standard, but understanding how they affect future fundraising flexibility matters. So, second, the no shop clause. Orion term sheets includes 45 days exclusivity provision, meaning once the term sheet is signed, Tariq and Nina agree not to actively pursue alternative financing discussions during that period. This clause exists because investors do not want to spend time on legal fees and internal resources on a deal, only to discover that founders was simultaneously shopping the term sheet elsewhere. This was also referred in our episode 1. Again, reasonable in the principle, but founders need to understand two things. First, the timeline is negotiable. 45 days is common, but some founders negotiate 30 days, 21 days, or structured extensions mechanism that require the investors to actively confirm progress before exclusivity continues. That creates pressure for the efficient execution.
Let me close the loop and give Tariq and Nina and every founder listening to 5 things to do. Step 1. Model your real ownership. Don't accept the headline valuation percentage. Build a spreadsheet. Start with the current cap table. Add the option pool at the proposed size. Convert any saves or convertible notes. Calculate Orion share. Step 2. Read the protective provision list in full. Write down every action that requires investor approval. For each item, ask yourself, could this restriction limit something I might need to do in the next 3 years? The $250,000 debt cap. The board composition changes. The new securities issuance. If any item on that list would have prevented something you did in the last 12 months, negotiate that threshold. Step 3. Model the liquidation preference at 3 acquisition prices. Use your best case, your expected case, and your downside case. If the liquidation preference is non-participating, as it's in Orion's term sheet, you are in good shape. If is participating model exactly how much the participating preferred compresses your proceeds at each price, then decide whether the trade-off is worth the investment. Step 4 is look up every anti-dilution and drag-along clauses and identify the specific trigger. For anti-dilution, is it weighted average or full ratchet? For drag-along, who needs to approve it? Preferred majority alone or preferred plus common? Is there a minimum price floor? These two words, weighted average common approval can take a clause from dangerous to manageable. If the words aren't there, they can be negotiated in. Step 5. Hire a startup lawyer for this transaction, not a general commercial lawyer, not a friend who passed the bar. A lawyer who works specifically with venture-backed startups, who has read hundreds of term sheets and whose job is to tell you which clauses are standard, which are aggressive and which are negotiable in the current market. The legal fee typically $3,000 to $8,000 for a seed round. It's the best investment you will make in the transaction. You are about to sign a document that will govern your life for the next decade. Spend $5,000. Let me close the loop on the story arc we have been building across this episode. The outcome you can get from here: Tariq and Nina have a $5 million term sheet on their kitchen table. They are going to sign it. They now understand every clause in it. The option pool that cost 15% of their company before the math is even calculated. The protective provision that means owning 58% does not mean controlling 58%. The liquidation preference that will determine whether they make money when the company is sold. The anti-dilution that will reshape the cap table if the market turns. The drag along that could one day force the vote they don't want to cast. The decision here is they are going to sign, not because the terms are perfect, because the terms are fair, the investor is aligned and the capital unlocks the next chapter. But they are going to sign having read every word, having modeled every scenario, having negotiated 3 clauses and accepted the rest knowingly. The lesson here is term sheet is not a formality. It's not the less important document before the real legal papers. It's the blueprint. Everything that happens to your company, every acquisition, conversation, every future fundraise, every board disagreement, every moment where your ownership and control are tested will happen inside the structure you agreed to on the day you signed this document. Read it, all of it, every time. That's the Inside the Deal process. I'm Gurmeet Kaur. With me is Nabun Sain. Thank you.